Welcome to Flippening, the first and original podcast for full-time, professional, and institutional crypto investors. I'm your host, Clay Collins. Each week we discuss the cryptocurrency economy, new investment strategies for maximizing returns, and stories from the front lines of financial disruption. Go to flippening.com to join our newsletter for cryptocurrency investors and find out just why this podcast is called Flippening.
Clay Collins is the CEO of Nomics. All opinions expressed by Clay and podcast guests are solely their own opinion and do not reflect the opinion of Nomics or any other company. This podcast is for informational and entertainment purposes only and should not be relied upon as the basis for investment decisions.
Welcome to the second and final installment of this deep dive on staking as a service, and generating returns for your portfolio with staking. I'm joined by Joe Buttram, founder and CEO of EON Staking. If you didn't catch our previous episode, I encourage you to listen to that first. In the previous episode, we discussed proof of stake consensus mechanisms, how this differs from proof of work, the best blockchains for generating staking returns, and the staking as a service business model. The previous episode provides the necessary context for understanding today's conversation, which is around regulation and the future of staking. As I mentioned in the previous episode, I've been blown away by how deep the staking and staking as a service rabbit hole goes. And I believe that this is the best content in existence on the internet about staking from an institutional investor's perspective. This two-part deep dive is broken up into 4 chapters. Chapters 1 and 2 were covered in the previous episode. In chapter 1, we explored what staking is and also shared a step-by-step process for participating and generating staking rewards. In step 2, we discussed the ins and outs of staking as a service, the best blockchains for staking, and the staking as a service business model. In this episode, we finish up chapter 2 and dive into chapters 3 and 4, which are about the regulatory landscape and the future of staking and staking services. We'll get right to the episode in just a second, but before we get started, I'd like to pause for a moment to tell you that this episode is brought to you by Nexo, who is making this content available for you to consume for free and who believes in education about the space. Here's a word from Nexo. Nexo is the world's largest and most trusted crypto lender, offering automated instant crypto credit lines, which allow you to use your crypto, for example, Bitcoin, Ethereum, or XRP, as collateral to get cash in over 45 fiat currencies and stablecoins without selling your crypto assets. Nexo also offers interest-earning accounts yielding up to 6.5% per year for stablecoins and euros. Interest is paid out daily, and you can add or withdraw funds at any time. Nexo is also a strategic partner of exchanges, OTC desks, traditional and crypto funds, helping them earn interest on idle stablecoin and fiat. The company's growing portfolio of structured institutional products includes fully collateralized, continuously rebalanced swap agreements, allowing counterparties to effectively manage their balance sheets. Check them out at nexo.io, and thanks to them for making this episode available to you. This episode is also brought to you by the Nomics API and CSV data export service. If you need an enterprise-grade crypto market data API for your fund, smart contract, or app, or if you need historical CSV dumps of trading data from top exchanges or even obscure ones, then consider trying out the Nomics API or our historical data export service. Our API enables programmatic access to clean, normalized, and gapless primary source trade data across a number of cryptocurrency exchanges. Instead of having to integrate with multiple exchange APIs of varying quality, you can get everything through one screaming fast fire hose. If you found that you or your developer have to spend too much time cleaning up and maintaining data sets instead of identifying opportunities, or if you're tired of interpolated data and want raw primary source trades delivered simply and consistently with top-notch support and SLAs, then check us out at nomicsapi.com. Or if you'd like to order historical cryptocurrency market data as CSV exports from top exchanges, email us at sales@nomics.com. Okay, back to our regularly scheduled program. Here's part 2 of my conversation with Joe Buttram from EON Staking. Enjoy. Do you always vote on behalf of the tokens that back you when your end users don't vote?
For some networks, yes, it's required.
Okay. Oh, so voting is required in order to earn a reward.
Not particularly, no, but for some networks, it's potentially going to be a thing. Yeah, they might upgrade to implement this feature, but it's not necessarily required. But if we want to vote, then it will be required that we have to vote on behalf of our constituents if they don't vote.
Right now, at least, one of your users can't say, I don't want to vote and I don't want you to vote for me either.
Yeah, exactly.
Do you put out position statements, or how do you communicate to your users what your general philosophy is and how you are going to vote on their behalf? Like, is there like, platform or, positioning kind of documents that sum these things up, or disclosures around that?
So this is a very interesting question that comes to, I think the crypto space in general, but also validators. But, in an extremely decentralized environment, how do you communicate effectively, right? We see this as like a big challenge generally, but also as a validator. So I could just tell you the way we go about it. So right now, most of our clients are private placements, so we just have direct lines of communication with them. But that being said, as these partnerships are rolling out that really reach out to a large group of people, our B2C platform is going to have direct governance portal, which sort of details these things. To date, what we do, and a lot of others do as well, is essentially use blog posts and Medium to sort of put these, as you said, position statements out there for the world to see.
You mentioned the B2C platform. In what way is your current platform not B2C? Like, if I come by and I've got $1,000 worth of Tezos, can I be your customer? Or is there a certain threshold that I have to surpass in order to work with you guys?
Basically, most of these systems are permissionless. So the nuance for us when we talk about a B2C platform is basically how, like, we streamline the process from start to finish, all in one place. Currently today, that, we didn't have a B2C platform out there, and token holder wanted to delegate to us anyway, they could. They would just have to go through the hoops of obtaining the tokens and, setting up their own wallet, and then going and finding our address, essentially delegating to us from their wallet, and then doing the accounting on their own on a block explorer. And the communications would probably be sort of difficult because, they could ping us directly or, on a forum post or something like that. But what we're referring to as our B2C platform is like that whole entire value chain is going to be a one-stop shop. So that's what we're releasing.
Got it. So right now, are you saying it is a somewhat complex process, or it's just more of a manual process where they need to contact you and you send them instructions and you go from there?
Yeah, I think you said it well. It's quite manual at the moment. If you're a delegator, you have to go and pull up your own native wallet. Then you have to delegate to your validator, and to find your validator, you have to go to the Splash page and obtain his address, and then you delegate. And then if you want to communicate, it's not necessarily a streamlined process. And then if you want to do your accounting, you go to a block explorer, right? As you said, it is manual and it is a bit frictioned. And so with our B2C platform, essentially that whole entire chain is going to be just on our web app and our mobile app. So they never have to leave.
So just providing good UI and an end-to-end experience. That's great. So is there a threshold right now for someone to work with you? Is someone kind of on their own if they're under a certain dollar amount, or you're just kind of taking inquiries as they come in?
Yeah, at the moment we take inquiries as they come in. But the other interesting thing too is if the delegator is savvy enough, and we do have those clients, they can just find us on their own and just delegate to us. And we have probably a good amount of clients that are doing that today.
How are you guys paid? How do you make money from doing this?
We operate on a commission model. So basically, any rewards that we make for our users or our delegates, we take a 5% commission on that. That is the main model that pretty much the majority of validators are using currently in the space. There are some other interesting models as well. We support sort of a SaaS model for some of these smaller networks that don't necessarily have as liquid of a market. We just basically determine a fee and then run the nodes for them. But there also is nodes as a service where people are, for individual clients, running their nodes for them, and they have their own agreements. But as a whole, the commission model is what's sort of the standard practice.
Is the commission model instantiated on chain, or is there some amount of trust that, if funds are flowing to you, that you're not going to take, 8% or 10% or 15%? Is it sort of hardened on the blockchain, or is that another area where folks have to trust you?
It depends on the network. For Cosmos, for instance, it is hard-coded, your reward on the blockchain. But in models like Tezos, for instance, the rewards are paid out to the validator, and the validator then distributes the rewards to their delegates. And from there, then you have to trust the validator as to how they're going to, basically split up those rewards and then take their commission and such.
I like the Cosmos model. With Tezos, someone could conceivably find out if you were doing something other than what you said you do. It would just probably involve a lot of complicated math and be a pain. Is that right?
No, I mean, they would just basically go onto the block explorer and see if that, did we take our 5% commission, and were we honest about that? So no, it's pretty transparent.
It is. Okay, got it. Yeah, I was thinking about you'd have to figure out what the lump sum was and then how many people is it divided between, but certainly they could do an easy calculation and see how much you took, but in terms of the distribution among everyone else and how much precisely they should get, that would be more complicated, or still that's pretty simple?
I'd say it'd be slightly more complicated, but as a whole, it's at least straightforward. There may be a couple hoops for you and a couple different calculations you have to make, but it's not hard to find.
I'm thinking through the legal agreements you have with your customer. So if someone comes to your homepage, fills out the form, gets something from you, maybe you sign some contracts, then those contracts protect an end user. But if someone finds you and just on their own creates an agreement with you or says that you're going to be their validator, do you legally owe them anything? Are they protected by documents that you have in place to protect other customers, or is it just kind of a trust-based system there as well? I'm trying to find the places of where trust needs to be versus not.
For us, we actually focused on this a good bit and was one of the early things that we really worked on pretty deeply. But to answer your question, it's pretty much the entire spectrum. You have validators that are in the cloud where they're anonymous and people are delegating to them with no sort of counterparty contracts. For us, we're public, we're based in the US, and we also have the thesis that, if you're a token holder with hundreds of millions of dollars, you're probably going to want some sort of agreement, right? So we personally have a very robust delegation agreement / terms of service, which pretty much details sort of all the backstops and all the situations that we've thought through that could potentially happen and guarantees. You're also seeing too SLAs sort of become more and more common in the space. So yeah, it just depends on the delegate, but the entire spectrum is available currently on the market.
Are there guarantees or insurance or measures in place to protect your customers in the event of a slashing?
We get this question a lot. So the fact of the matter is that we've looked into insurance products for staking and particularly slashing. It's so new and novel, and the risks are so high that we haven't necessarily found anyone that's super keen to take it on just yet. That being said, it will probably become a standard in a product years from now. But currently, to date, most of these staking as a service providers are also startups as well. So, there's essentially, limited reserves and whatnot. For us, depending on the asset and the individual agreement, we will do our best to, help users in the slashing events in terms of monetary, forfeitures and whatnot. But as a whole, yeah, I mean, if we're successful and, managing, tens of billions of dollars and, you get slashed for 5%, that's a lot to cover. So hopefully by that time, obviously there should be sufficient cash flows in order to do that, like what Binance is doing today. But it's still very early, so those products aren't necessarily really on the market yet.
Just to dig into slashing a little bit, are there instances in which your users could get slashed due to no fault of yours with regards to execution? Can you be doing everything perfectly and have your customers' funds still get slashed?
By doing things perfectly, that sort of has to fit within the context of what the consensus of the crowd and the blockchain looks like after a fatal event, right? So if there's a chain split and, for some reason we think we're doing the right thing and people migrate to another chain, it's not necessarily who was right or wrong. It's what the consensus was, right? But that being said, we fully intend to, go along with that, with that crowd decision. And so it shouldn't be an issue. I think the other thing to note too, though, is like these different proof of stake mechanisms have different sort of flashing requirements. So in Tezos, for instance, the validator has to put up a self-custodied bond, right? So basically the company EON has to put, or any validator has to put up at least 12% of the entire pool of assets you're managing as sort of the slashed collateral. And so if we do, if validator it was to do something that enforces or requires a slashing event, the delegates aren't affected, but the bond, which is that 12% that the validator's holding, would be subject to slashing. So it really just depends on the network.
As the validator, it's only your funds that are at risk and the delegates are not at risk.
On Tezos, yeah, but on networks like Cosmos, everyone is at risk.
It definitely does seem like Tezos has thought a lot of this through pretty well. I like the Brightmans.
Yeah.
You mentioned some of the legal agreements that you've had developed. That's interesting. Where do you go to find an attorney who's going to work with you on this? Like, can you speak a little bit to who your legal counsel was, the precedents that they drew upon? Were there any existing models out there, or is a lot of this kind of custom stuff that you've developed on your own?
In terms of how we find the information, our first hire was actually our general counsel, Evan Weiss, former corporate attorney at Holland & Knight. And so he obviously is in the weeds every day thinking about staking. So he does a great job, working on that side of the shop for us. We basically, with his help and some of the connections we had previously, the main firm that we have retained is called DLX Law. They were a firm, or are a firm, that pioneered the 2014 FinCEN mining decision. So they had a lot of really good in-depth knowledge on, how sort of transactions work on a blockchain. And so we worked closely with them to, work out the nuances in proof of stake, and they've been extremely helpful on that end.
Joe, what are your customers most interested in when it comes to these documents and coverage?
I would say the most important thing to them is what happens in a slashing event and what are the recourses, right? We are pretty straightforward about everything there. And so I think it's on top of that, it's just the certainty of the parameters, right? They just, even though it may not necessarily be, 100% what they would write, they're just happy that they're like, okay, there's something here that we can lean on, and they have a good head around as to, what our services are and what we offer. And then we're seeing a lot now about SLAs. So basically, what are some of the guarantees that we're giving in terms of our operating? So like, our nodes and our infrastructure, and a big one too is communications. A little hack that we can see happen is, if you're a third-party validator with an exchange, and the communications aren't robust and secure, can somebody just plug in their own validator address and, for 3 weeks or an indefinite amount of time, be earning rewards and keep it all for themselves? So those are sort of the things that we're seeing that our clients are really appreciating.
An example of an SLA might be that your nodes are up for a certain amount of time so that they're around if they need to validate a block or vote on a measure. Is that right, more or less? That's
definitely the biggest one. On top of that, it's like, what are our communication timelines in events of slashing or, upgrades or forks or things that we need to work with them on in a diligent fashion, like responding in 6 hours or 3 hours or 1 hour or something like that.
Just one point of clarification. You have full-time in-house legal counsel right now. That's like a full-time position. Is that correct?
Yep.
That's crazy. For a startup. Yeah, I don't. How many people are at EON right now?
Currently 7 of us. I mean, Evan was our first hire, and he's a good friend of ours and very educated on the space. But yeah, I mean, our thesis was that as the space becomes bigger and bigger in regards to staking, that's more and more of these counterparty certainties need to be really detailed out, and it's such a new space, and all the things with the regulatory stuff too. It really just helps me sleep better at night having him on the team.
My questions don't come from a place of criticism. I just don't know of any 7-person startups that have full-time in-house like legal counsel, and I think it just speaks to how new the space is and the importance of regulation and a whole bunch of stuff that you need to think about that probably have never had to be, people have never had to really think about before.
The regulatory overhead in crypto is so high, and for all these new, mission critical products, it definitely helps us move a little bit faster and with more certainty. And, as a lot of other startups have to think about this thing, or startups in crypto have to think about the legal and regulatory at one point or another, right? So
when people come to you guys and, let's say someone comes along and they have a lot of capital crypto assets that they want to stake, and maybe they're looking at you versus another large competitor. I'm sure there's a range of options that people consider when they're going to do this. Or like, we could do this ourselves. We could go with you. We could not do anything and not risk flashing, or we could go with this other competitor. What are the points on which you end up differentiating and sort of winning customers? Like when you do win the deal, what's usually the reason why?
That's a great question, and something that comes up a lot when people just talk about validators and staking as a service generally, because there's so many similarities. Like, how do you differentiate, right? So for us, our network is pretty strong. So being able to have relationships with these folks to build that trust is just something that generally helps out a lot. But on top of that, again, it comes to our legal and regulatory. Like, they can have discussions with us on our conversations with all the regulatory bodies around staking, and all the work that we've done, and all the nuances on tax, and when they look at their delegation agreement, they really appreciate it, because one of our biggest clients is the network has yet to launch, but he has many millions of tokens to stake, and it's a big decision for him who to go with in that regard. And so we knew him ahead of time, but he really we sat him down for days and had many conversations on sort of like how it would look structurally, legally, and what he would have to think about from a tax side, and also regulatorily, because he was such an early investor. So all that sort of stuff gave him a lot of certainty and calm when he decided to go with us.
Let's transition to chapter 3, which is on regulation. What are the laws that you're regulated by, or that you suspect you're regulated by, but maybe aren't sure of yet? How do you think about the regulatory landscape?
One thing we pride ourselves very deeply on is our work in that sort of the house, in that sort of the space. So we put together a trade association called the Proof of Stake Alliance, in which we're basically going out to seek more clarity from all the regulatory bodies when it comes to proof of stake, because it's such a new thing on the marketplace, and it's going to affect so many people that are holding tokens. We've done a lot of work into that. So to get a little bit more deeper into the specifics of your questions, I'll just go over, just off the top of my head, some of the ones that probably we put the most amount of effort into based upon sort of the concern. So first is tax, right? Like, that one is such a gnarly thing that, token holders have to consider, because there is no sort of precedent at the moment for just proof of stake that you can really have a one-to-one comparison to. And if you want to, essentially compare it to some of the other things that are out there, it's not necessarily favorable, and it doesn't make as much sense. Like for proof of work mining, a lot of it, like miners have to pay ordinary income in the United States, but obviously that would really affect a token holder's decision to even stake, because if they have to pay, denominated in US dollars every block or cycle, and they want to compound their rewards over a period of time because they're long the project, that's going to throw a wrench into the situation, right? So that one we thought pretty deeply about. There's, again, a lot of different nuances to it. And we're basically talking to one of the big four at the moment to, basically work on a framework for that. So we'll be open sourcing that within POSA, Proof of Stake Alliance, when that is ready.
I'm playing armchair CPA here, but because it's a more kind of like passive form of income, someone can just delegate to you guys and just kind of like sit around. It's very different from being a miner where you have to purchase equipment and you have a machine that's actually doing work day in and day out. Do you have a stance, or is there consensus around if this is ordinary income or not?
It really comes down to each network, in our opinion. What, again, not a CPA, but from the work that we've done. At the end of the day, if you're expecting to make income from something, it should outweigh costs, and it should be a profitable venture for you, right? And so if the network is, if you're a staker or a delegate and you are wanting to participate in these networks at call it steady state, in which 2/3 of the network is staked and the inflation rate is at optimal, which is the lowest it should be based upon the design decisions, you're not necessarily making a profit, right? That sort of changes the whole idea of ordinary income. With some of these networks that have governance, it could be likened to a stock split. When stocks split, you don't go and pay on the pro rata shares that you get. And so, but for some of these networks that have 100% inflation, that could be seen differently in the eyes of the IRS. So it's a discovery process. We'll have to see, but those are some of the early observations we've made as we build out our framework.
So it might be somewhat analogous to owning a government bond whose returns roughly match inflation. Is that ordinary income? And the answer is clearly no, I believe. So the first area is tax. What else do we have in terms of regulatory categories?
So the next thing we've thought about a lot is the SEC and any potential securities or investment contract issues. So the SEC is pretty approachable. They had an open forum where you can go and just talk to them. And so we've set up those meetings and had those conversations. As a whole, we were mostly concerned is the relationship between the delegator and the validator an investment contract, right? Because if you look at the 4 pillars of the Howey test, first is investment of money, which, you're aggregating funds to do something. So that could be seen as that a common enterprise. Clearly, it's, something that we're all working towards to earn these rewards. Next is expectation of profits, which again is just, have to be something that is on a case-by-case basis, we believe. And then the managerial efforts of others. So that was one thing we looked into pretty deeply. And we think that if presented the right way and structured the right way, and there's an honest arrangement between the delegator and the validator, those things can be worked around, we believe. It's still to be seen. It's such a new thing, but those were initially our original concerns. Again, to go into these things a little bit more deeply, investment of money, is there a risk of loss when it comes to that? That's a big piece of that. For some networks, yes, slashing is, subject to everybody, but for some networks, no, it's only maybe the validator or none at all. So that's something that's important to point out. In expectation of profits, again, if these inflation rates on some of these networks are outsized, they're potentially optically could look as though you're expecting profits. And on top of that, it's also how you're marketing, right? So if you're saying to people that, hey, you can make a bunch of money with us, send us your money, that is more likely to be an investment contract or some sort of securities issue. But if, you're really just saying, hey, we're providing a service and, we're not trying to necessarily, promise you like 10x returns or whatever, that's obviously going to be more favorable upon the past examples we've seen throughout securities law history.
Hey, I want to pause for a second to let you know that this episode of the Flippening podcast is brought to you by the good folks at Nexo. Here's a word from them. Nexo is the world's largest and most trusted crypto lender, offering automated instant crypto credit lines, which allow you to use your crypto, for example, Bitcoin, Ether, or XRP, as collateral to get cash in over 45 fiat currencies and stablecoins without selling your crypto assets. Nexo also offers interest earning accounts yielding up to 6.5% per year for stablecoins and euros. Interest is paid out daily, and you can add or withdraw funds at literally any time. Nexo is also a strategic partner of exchanges, OTC desks, traditional and crypto funds, helping them earn interest on idle stablecoins and fiat. The company's growing portfolio of structured institutional products includes fully collateralized, continuously rebalanced swap agreements, allowing counterparties to effectively manage their balance sheets. Check them out at nexo.io. Again, that's nexo.io. This episode is also brought to you by the Nomics API and CSV data export service. The Nomics Market Data API offers squeaky clean and normalized primary source trade data offered through fast and modern endpoints. If you're a professional investor or developer, you need accurate prices, and I can tell you that our competitors' prices for the most part are not accurate. We're actually going to come out with a report about this soon. I should also note that the Nomics API is used by many of the largest and most influential companies in the space, including top exchanges, $100 million plus AUM funds, and prop shops. Hit us up if you'd like more details or go to nomicsapi.com. Furthermore, if you'd like to order historical cryptocurrency market data as CSV exports from top exchanges, email us at sales@nomics.com. Okay, back to the show.
The managerial efforts of others is pretty interesting. So you have to think about a couple things, particularly what is the primary purpose of sort of the relationship? Are you just, handing over your money over to somebody and then just like never doing anything and expecting a whole bunch of money back? There's an involved process for a delegate when they choose their validator. It's not a simple thing that they can just do, right? If you're upfront about it, this is why when you go to different trading firms, they, have a questionnaire for you to know that, you know what you're doing. And so, having that clear understanding with the relationship of your client and customer or delegate is something that needs to be thought about as well when it comes to the investment contract issue. That being said, we feel much better about that as time has gone on. The thing that I think is sort of the unknown and interesting thing is, does a validator require a BD license to support certain networks that may be deemed securities? The SEC has really only publicly said Bitcoin and Ethereum, but what about these other ones, which are the majority of proof-of-stake networks out there? If they did their raise in a way that maybe wasn't as kosher as the SEC would have liked, or they're not decentralized enough, or they're clearly, as a network, relying upon managerial efforts of specific parties, that potentially could run into issues if we decide to support that network and other validators as well. So from a security standpoint, those are the two biggest issues that we've identified and that we've been working towards. I think as time goes on, we'll get more comfortable with the latter, but the investment contract issue, I think, can be mitigated pretty decently.
Just thinking about the Howey tests, there's the investment of money. Obviously, that's happening into a common enterprise. That's questionable. Is a cryptocurrency network a common enterprise? I would say no, it's not really an enterprise. It's TCP/IP an enterprise. And then reasonable expectation of profits derived from the, managerial efforts of others. I mean, one might say that that's what you guys are doing, but then on the other hand, is a TESI or whatever it's called, does it morph into a security just because, you're handling it for someone? Like, does it transmute? Like, no, it doesn't. So it's not like you just invented a security because you're possessing it and, facilitating what they're doing. So, and you're not actually like managing their money or deciding to allocate it. Like you're not moving funds in and out of a staked state, are you? Right? Like if delegated to you, then they're permanently being staked, and there isn't active management happening other than, sometimes you'll vote on behalf of others. Is that correct?
I think you touched on it pretty well. One other thing I'll add to that is, we really do see ourselves as service providers because, in the Howey test, this is a lot of times like focused on, equity and some of these other things. We're just performing a service. Our delegates don't necessarily have rights to EON or, rights to equity or the shares or anything like that, right? There's, again, each protocol, each instance, each case, each marketing package is all going to be different as it applies to the Howey test. But I think you hit the nail on the head with a lot of that stuff.
So is there another regulatory category in addition to tax and the SEC bucket? Is there a third?
There are two more, but the next one I'll touch on is FinCEN, and particularly FinCEN and on the state level, particularly when it comes to being a money transmitter and a money service business.
Hey, this is Clay, cutting in again to define FinCEN, which stands for Financial Crimes Enforcement Network. FinCEN is a bureau of the United States Department of the Treasury that collects and analyzes information about financial transactions in order to combat domestic and international money laundering, terrorist financing, and other financial crimes. Okay, back to Joe.
That was one thing that FinCEN in 2014, they deemed that Bitcoin wasn't necessarily like that for the miners, but what's the relationship like now that there are the sort of constituents or delegates that we're interacting with, right? And so we feel pretty good about that because we're not necessarily transmitting money from a person to person. We're just interfacing with the blockchain. And, if there is any routing of tokens, it's just going to go back to the original proprietor that we're working with. So that we feel pretty comfortable with when it comes to a money transmission standpoint. And from an MSB license on the federal level, the one big thing we think about a lot, which is probably going to come more to light as time goes on, is KYC, AML, and terrorist financing. So this, I think, is the biggest question when it comes to the regulatory space with proof of stake, particularly because a lot of these networks and a lot of these protocols are permissionless. So, you necessarily, on some of these networks, you can't stop delegations coming to you. And that's most of them, actually. But I think the key thing is you can't stop payouts on some of these networks as well. So that is something, because at that point, you can't really enforce KYC AML on some of these networks, right? If that's happening automated on protocol, it's outside of our ability to control. And one of the examples that you come up with is okay, what if an OFAC country or someone from an OFAC country is looking to stake assets? What if they can just do it to any validator of their choosing, and the rewards that are earned they can keep, and no one can stop it. That's going to be an interesting thing that the community and the regulators are going to have to start looking into. Definitely the toughest aspect of this whole thing. There are some networks that do have some wiggle room for us. So currently on Tezos, the payouts are sent to the validator. So for us, if people don't KYC with us, we can essentially just not send the funds to them. We'll be hopefully more in line with the KYC laws if we're able to, essentially be able to have a say in the payout structure. So that is the next big thing that we think about when it comes to the regulator space, and something that we'll have to think about more and more as time goes on.
Do you require KYC AML from 100% of your users, or just ones who come in through the front door?
On networks like Tezos, for instance, if they don't do it at the front door, we can sort of manage the process on the back end with the payout structure that I mentioned. But for some of these networks that are permissionless, we try to enforce it as much as possible, but there are some things that are just out of our hands.
Let's say hypothetically someone on the Tezos network, delegates to you, and it's just all on the blockchain, and you are holding their funds. Well, I guess that's how they'd get in contact with you. You would be holding, and so in some cases, in most, maybe all, it'd be impossible to find them. But people have a way of finding you when you have their money. Then you just ask them to fill out the paperwork, and you'd proceed from there. Is that right?
Right. And the CFTC is a big player when it comes to regulating a lot of this stuff. So we actually don't think that proof of stake falls under the CFTC as much. We're not offering swap products. It's not a futures contract. It doesn't necessarily fit within the scope of the CFTC. So, outside, the biggest thing that the CFTC would probably look into when it comes to proof of stake and validators is for basically fraud, right? And so we should be acting in good faith anyways, and so that should mitigate, the CFTC issue. So they seem pretty progressive too with a lot of the new stuff that's coming out. So we feel pretty confident on the CFTC side. The last bit is back to securities, but more particularly FINRA for broker-dealer stuff. So we think we have an asset listing framework. Basically, as I sort of discussed, is there potentially an issue supporting a security on our platform? So we've thought deeply about that, and FINRA, if you do get a BD, would expect. And so that's the biggest thing with those guys. That's kind of it on the regulatory stuff. It's very in depth, and it's always changing. But I think they're definitely. I feel good about proof of stake because there's definitely we can work through these processes, right? It's not like a full stop. So
let's move on to chapter 4, the future. What do you see the future looking like? I've heard people speculate about some of this stuff moving to wallets, having voting and maybe communication with stakers, or even just users of a given network moving to the wallet as a communication channel. You've spoken about custody services or exchanges, maybe working with you to provide staking services to their users. it's kind of hard to peer too far in the future in this space, given how new everything is. But what do you see the world looking like? Let's not get too crazy, like 3 years from now.
A lot can happen in 3 years in crypto, though, you know? I mean, this is one of the things that gets me so excited about the space. I mean, right now it's very much focused on, aggregating AUM and clients and distribution and that sort of stuff. But I think proof of stake could potentially be a big unlock for a lot of different applications within the blockchain realm. So on that note, we're obviously seeing governance is a big thing. People now can, more effectively, have some weight behind a voting structure, which wasn't necessarily possible before. I mean, on a proof of work system, the votes were kind of happening, from clients and wallet users and exchanges running nodes and miners picking which network to focus on. But now, the token holders themselves are now a bigger voice and could, now literally vote. So that's something that's really cool that's happening. It's obviously going to have its own host of challenges, but we're seeing it in the wild now in the early stages, and a lot of cool things can be had from that. On top of that, there's just, the financialization of this yield stream that's happening, with these rewards on networks. So we've talked a little bit about the pre-interview with, fixed income products and structured products. Now we're able to, basically chop up the inflation curve and potentially hypothecate more and more assets to create more and more value within the ecosystem. And I've thought a lot about this with my friend Lawson Baker, who has a good Twitter presence on some of this stuff. And basically one of the cool things that can happen with sort of these products is, most of them have maturity dates of, call it 6 months to 30 years, but who knows what's going to happen during that time frame. So what could potentially happen is that when these products do come onto the marketplace, the turnover is going to be much shorter and the maturities are going to be much shorter. And, more and more trading volume can happen from there. And I think that's extremely interesting. And transitioning to the trading stuff, I think that is probably going to be the most immediate thing that happens. That is just really fascinating when it comes to staking that we're already seeing right now. So one of the big things is circulating supply, right? Is CoinMarketCap and some of these other price feeds going to reflect, the price based upon the circulating supply that's on the free float market that's actively being traded? Or are they also going to couple in staked assets that are unlocked? Or on the contrary, if people stake assets, does that reduce the circulating supply and hence the float? We're already seeing interesting trades happen on that side of things. And so I think one that's particularly fascinating right now is with Cosmos. So Cosmos, they had their ICO early 2017, and the ICO participants, have been waiting for a long time. And when the network launched, it was anywhere from 20x to 100x, right? And so that's a lot of gains that people are sitting on. In terms of how the blockchain kind of came onto market, initially Cosmos unleashed their blockchain onto the world with locked tokens and transferability. So basically they wanted to ensure that mainnet was stable enough before they allowed for trading. And so what happened was that a lot of people went and staked on during this unlocked period. And the bonding period, which is the period that you can delegate and undelegate from on Cosmos, is 3 weeks. So if you delegate to someone on Cosmos, you have to stick with that validator for 3 weeks before you are able to move your tokens around again. And so this is really interesting because when they were voting on governance to enable transferability, essentially they had a 2 week period in which once they voted for transferability, it would be unlocked. But then they had a vote that shortened that to 2 days. And so basically when transferability was enabled, a significant amount of ICO participants were stuck in that bonding. And so now within the next couple months, we'll see all those token holders unbond and potentially trade on the marketplace. And what does that do for the price of the asset and the liquidity of the marketplace? So that is something that is extremely fascinating to see, as that sort of changes the dynamic and landscape of probably the biggest use case in crypto right now, which is trading.
When you look at your product roadmap, big shifts that might come down the pike that you might have to adapt to or respond to, other than the regulatory stuff, what might they be? Like what it sounds like first and foremost, you guys are really focused on a B2C model, having a really seamless UX and UI kind of wrapper around what you're doing. What comes after that?
Concurrently, we have a lot of partnerships right now, currently teed up that we'll be announcing over the next month or plus. But a couple exchanges, wallet providers are extremely interested in this because a lot of wallets, they don't necessarily have a monetization model. So now this clearly gives them a path to revenue that wasn't there before. And, it's a value add product for their users, and not just wallets, but in our opinion, every service provider in the space that they'll have to probably implement at some point, at least the majority of them, so that they can retain their user base over a length of time. So that's particularly interesting as well. The only other thing I'll add is like a big shift that could potentially happen. We talked about this a little bit in our pre-interview, is, this could potentially change, the nature of the custody model, right? Where now custodians are charging bips on AUM for their clients, but, potentially if a validator were to decide to take custody, now they can actually pay their clients a fee for the right or the ability to hold their assets, right? So there's a lot of interesting shifts that staking potentially enable in the space.
I know that wallet providers for a bit there were earning revenue by integrating with services like Shapeshift that would allow for folks to exchange one crypto asset for another, and the AML KYC process kind of created a lot of friction there, and people were less likely to sign up, but just the conversion rate on that went down. I imagine that KYC AML would still be required of users of a given wallet if they were going to integrate with you and provide your service as a service. Is that correct? There's no case in which KYC AML doesn't have to happen apart from huge regulations saying otherwise or changing.
For our wallet partners, that is the case. With exchanges and other users or other partners that are taking custody, basically within our agreements, we tell them like, hey, you should be doing KYC anyway, and we're essentially able to relinquish our responsibilities there. But yeah, for wallets, yeah, it's a thing.
One thing that I've been contemplating is generalized mining, and how that is often a service, more or less, that a VC or an investor might provide to a network that's just getting started, to both secure the network and also to generate a return for the investor, above and beyond what they already paid for during a SAFT or something like that. Do you see something similar happening? Is there generalized staking? Is that a thing?
Yeah, totally. I mean, we're seeing it with governance, but especially when you need to sort of leverage the wisdom of the crowd and reliable data from many, many users. Particularly, one that comes to mind is Augur. All the rep users, the rep holders currently, that scales and potentially becomes a huge, DApp that people would want to use. And the market caps become sufficient enough and large enough, and the institutional investors that come in end up buying it and wanting to participate in that function. I can totally see, a service provider that specializes in that, and we definitely plan on it for some of these in-depth staking or generalized mining services.
Well, that wraps up this two-part series with Joe Buttram from EON Staking. I hope you enjoyed it. Before you go, I want to mention that since we've started producing episodes at a much higher rate, we now have room for a few more sponsors. If you like the work that we do here and would like to support this show, then a sponsorship might be a good fit for you. I can say from our own experience that flippening sponsorships work. Each and every time we put out an episode of this podcast, we mention our own API, and to date, every single one of those advertisements has resulted in at least one customer. In fact, we would do these shows even if nobody else sponsored because of the business it brings to us. And over 80% of paying customers mentioned that they heard of us through our podcast. If you're interested in sponsoring the show, please hit us up at support@nomics.com. All right, that wraps up things for this week. Stay tuned for next week's episode. Until then, take care.
That's it for this week. To sign up for our free crypto investing newsletter, listen to other episodes, or get the show notes from this episode, please visit flippening.com. I also invite you to check out the startup that funds this podcast, Nomics, spelled Nomics, at nomics.com. Finally, if you got value from the show, the biggest thing you can do to help us out is to leave a 5-star review with some comments and feedback on iTunes, Stitcher, or wherever you listen to podcasts. Thanks for listening, and see you next week.